How does the death benefit work in the infinite banking policy? We're going to dive into that today, but first, make sure to hit that subscribe button so you don't miss another video. The death benefit can be a confusing piece of the infinite banking strategy, mostly because a lot of people that are talking about infinite banking or understand how to do this are constantly talking about the need to decrease the death benefit as low as it can go. Now let me clarify what's happening here. The IRS has very specific guidelines for what an infinite banking policy or a whole life policy can look like. These guidelines that the IRS has set are called the Modified Endowment Contract, or in short, the MEC limit. All this is a calculation between how much death benefit is in a policy and how much premium is going into the policy. For every $1 going into the policy, there has to be X amount of dollars in the death benefit. Now, what the MEC limit is actually affecting is how these policies are taxed. If we stay under the MEC limit, then everything in the policy, whether it is coming out as policy loans for infinite banking, whether you're taking out as pure income, or whether it's the death benefit being paid out, all of this is tax-free. If we go over the MEC limit or create a modified endowment contract, everything in the policy becomes taxable. You can see why most people want to make sure and stay under that modified endowment contract limit, because the tax-free nature of the strategy is pivotal. So yes, we do want to decrease the death benefit as low as it can go according to the MEC Guideline, because that helps the efficiency of the cash value piece of the policy to grow as efficiently as possible. When you're utilizing this as a infinite banking strategy, this is extremely important because you want the cash value piece of the policy to be working as a fine-tuned machine. The death benefit is something that my clients view mostly as an added benefit that they don't have to pay for in any other way. Now, unlike term life insurance where there's a set death benefit and it does not change through the term of the policy, an infinite banking policy will start with a death benefit and it will increase over time. What's happening is as you put premium into the policy, a good portion of that premium is what's called paid up additions. These paid up additions are actually purchasing fully paid for life insurance, and that's why that death benefit is increasing. At the same time, those paid up additions are pivotal in increasing the cash value of the policy. As the cash value increases, that pushes the death benefit higher. What's happening is the death benefit over time is going to slowly get more and more expensive. However, you're going to be paying for less and less death benefit because your cash value is replacing it with paid up additions in the life insurance policy. This is why when somebody dies with a whole life policy, they're not going to get paid out the cash value plus the death benefit. The cash value is part of the death benefit. What's happening over time as that cash value increases is you're paying for less and less death benefit. In fact, at the age of 121, the cash value is going to equal the death benefit. Now, not very many people make it to 121, but if they did, they would receive the entirety of the death benefit. Every time you fund the policy, that's going to cause a jump in the death benefit. Now, if you're just paying the base premium, that jump is going to be correlated to the base premium. If you're paying the base premium plus paid up additions, again, that death benefit is going to jump according to the amount of premium that you put into the policy. Now, let's say you're 10 years into having an infinite banking policy and you're not funding it anymore. The policy itself is going to continue to grow and compound with the guaranteed interest plus the dividend. This guaranteed interest and dividend is going to go right back into the policy as paid up additions, so it's still going to increase the death benefit. So even when you're not putting premium in, that death benefit is going to be increasing. With most policies, you can also do what's called a reduced paid up. What happens here is once somebody gets to a place where they're not necessarily funding the policy anymore, they still want to use the policy to loan money in and out, go out and create wealth, but they're just not going to put any new premium into the policy, you can do what's called a reduced paid up. Essentially, what's happening here in a reduced paid up is you're taking the death benefit and you're dropping the excess death benefit that you're carrying on the policy that you have been converting with the paid up additions, and you're dropping that off the policy completely. So what's going to happen is it's going to be a temporary reduction in death benefit, but by doing this, it actually will allow your cash value to grow more efficiently. And so even though there's going to be a reduction in death benefit, over time that death benefit can be made up and it will eventually likely surpass where you were at the time you stopped funding. When the death benefit gets paid out, it's going to be paid out tax-free. It doesn't matter if it's paying to your children, a charity, or a trust. Any death benefit that the infinite banking policy pays out will be tax-free, assuming that it is under the modified endowment contract. If you have any questions about the death benefit, or maybe it's about the paid up additions, make sure to drop it in the comment section below. Make sure to like this video, and as always, hit that subscribe button. That greatly helps me out, and we'll see you on the next video.